Hello everyone. Today we're going to be talking about something called as an ISA. You would have seen this if you live in UK. You would have seen this in newspapers or advertisements somewhere or the other. So an ISA stands for individual savings account. Now, what is an individual savings account and why is it important? People living in UK will know that almost everything is taxed. I mean, all the income is taxed, apart from your personal allowance, which you get about £12,500. After that, whatever you earn is getting taxed in UK. And till about 3 or 4 years back, even the interest that you get from your bank account, it was also getting taxed. Like for example, even though the interest is very small, I mean, even if you earn like £100 in bank interest, let's say, a lot of bank accounts like Santander was giving 3%, there were some banks that were giving 5%. So if you maintain like around £10,000 in your bank, you might end up getting around close to £100 or £150. So even if you got like £100 in interest from your savings account, you need to pay tax on that as well. You needed to pay tax on that as well. For example, if you are a higher rate tax payer, then for £100 you will be able to retain only £60, and £40 you need to pay back to the government as an additional tax, because that was also getting taxed. Which is when the concept of the individual savings account was created, where you don't need to pay tax if you get the interest within an individual savings account. It was like a bank account, but if you put it into an ISA account, then you don't need to pay tax on it. Now the scenario has changed, where the interest from your bank account is not taxed for a large slab. So for example, for the first £1,000, the interest is not taxed. So to actually pay any tax on your interest from your bank account, you need to get an interest of above £1,000, which is very unlikely, because you need to because the interest rates, like I said, are around 1%, 1.5%, which means that you will need to keep a bank balance of above £100,000 before you start to pay tax on the interest, because that's only if you have like a bank balance of nearly above £100,000, which is when you will get an interest of above £1,000, even with a 1%. Now, while this might look like an unlikely scenario, people who are selling a house and they are going and renting a house for a period of time before they are going to buy another property, for example, they might have this kind of amount in their bank account, and you might end up getting more than £1,000 easily, because you're just keeping the amount in your bank account for a period of time. Now, in that case, your interest is going to be higher, and you actually have to pay tax. The other scenario is that if your yearly salary is exceeding £150,000, bonuses or whatever it is, all the income put together, if your yearly salary exceeds £150,000, then you don't get any allowance at all for your bank account interest. Even if you get like £10 bank interest, then that is fully taxed, and that is taxed at the highest tax slab that you will be paying into. So which means that even if you get £10, you will probably end up paying like £5 or more than £5 in tax, because your tax would have exceeded 45% tax slab at that point in time. So in reality, the cash ISA or the savings ISA that used to be there, the savings account in the individual savings account ISA type, was useful only for is useful only for a very small percentage of people, because not many people would have more than 100,000 in their bank account, or would be earning more than £150,000. So naturally, even if you keep it in a normal bank account, you're not going to pay any tax on that interest. If you keep it in an ISA, you're not going to pay any tax on the interest. So there's absolutely no tax differences in terms of a cash ISA. Now, which is where the different types of ISA come into picture. There are actually 4 types of ISA. The first one is the cash ISA, which we talked about, which is basically like a regular bank account, a regular savings account, where the interest is not taxed no matter how much interest you get. So even if you put £1,000,000 in it and you get £10,000 interest out of it, that is not taxed, and you can keep the whole interest in your account, and you can use it for whatever purposes you want. So this, like I said, it's not very useful. So what are the other 3 types? The other 3 types are really useful for people with varying amounts of money. Even if you have like £1,000 that you want to actually save, or you want to invest, or you want to make more money out of it, then the other 3 types of ISA are very, very useful. So cash ISA is the first one. Then we have what is called as the investment ISA, or the stock and shares ISA. Now, this is more or less, there are two options available. One is like a mutual fund, where you buy into a fund where they invest, the company will invest on your behalf. Like, you know what a mutual fund is, right? The company will invest on your behalf into multiple investments, and they will give you a percentage. They'll agree with you, depending on the performance of what they invest in, you will get a small portion back. And the other option is, in the investment ISA, there is another option, which is stock and shares ISA. This is actually interchangeably called, so it could either be called as a stock and shares ISA or an investment ISA. The other option is, you can directly invest in stocks or shares by buying shares directly. You can even day trade. And if you have a normal stock account or a share account, and you buy and sell a share, the gain that you make is basically a capital gain. And if you exceed your allowance for capital gains tax, which is around £12,000 per year, then you will start paying tax on a normal share account. So the stock and share account is going to be helping you by, if you want to do a trading, you can actually open a stock and share ISA under the investment ISA option, and then you don't have to pay tax. This is actually a very interesting ISA. The third type of ISA is something called as an innovative finance ISA. Now, the innovative finance ISA is a peer-to-peer loan option. So, wherein in the previous examples, you were either putting your cash in your own bank account and the bank gave you an absolute safety. In the second case, it's like a mutual fund or a stock and share where you decide where to invest it. The third option, innovative finance ISA, is basically like a peer-to-peer loan, where you are going and giving that amount as a loan to another person. It's a peer-to-peer loan, and the interest rate is generally much higher than a savings ISA. So where a savings ISA, you will get an interest of like 1% or 1.5%. In a peer-to-peer loan option or a innovative finance ISA, you could end up getting like about 3%, 4%, or sometimes even higher than that as well. There are multiple companies that let you do this. Like they will have the portals and everything where the buyers or the people who want these loans, they will come and apply. They will do the credit checks. They will do all the paperwork, and all you have to do is basically choose what kind of peer-to-peer loans you want to give. Like, do you want to give loans against property? Do you want to give loans against buying a car? What kind of peer-to-peer loans you want to do? There are several options out there. The one thing to remember is this innovative finance ISA, the peer-to-peer loans are not protected by any guarantees like FCFS guarantees. It's not protected, which means that this is the highest risk that is out there. The fourth option, which is probably the one ISA where you can get the most out of it if you use it properly, is called as a lifetime ISA. Where it's not a short-term plan like the other funds, like all the other three funds that we talked about. You can take the money out quickly in a year's time or 2 years' time, depending on what you've invested. Sometimes even quicker than that. Like, for example, if it's a stock and share ISA, you can buy a share in the morning, you can sell it in the evening, you can take the money out immediately. But the lifetime ISA is a long-term ISA. So the option is that you can pay a certain amount into the lifetime ISA up to a maximum of £4,000, and the government will give you up to 25% back, which is up to £1,000 basically, into your ISA account. They will invest, but you can't take the money out. So you can use the money only for buying a property or when you retire above the age of 60. So these are the only two circumstances that you can normally take the money out of that account. But if you think about it, for every £4,000 that you invest, you get like £1,000 from the government, which means that theoretically you can make like £1,000 every year. So if you invest for 20 years, you can get about £20,000 from the government as an additional amount for buying a property. So if you're age 20 and you want to buy a property at 40 and you keep investing £4,000 into it, in 20 years you would have got an additional £20,000 in your ISA account for buying a property. So again, there are a lot of options to consider. The biggest caveat is the amount of money that you can invest in a financial year. A financial year is from April 6th to April 5th of the next year. So for example, the financial year of 2019 was from April 6th of 2019 to April 5th of 2020. So in one financial year, you can invest up to a maximum of £20,000. And this £20,000, you can decide how much you want to invest in these four types of ISAs. So theoretically, other than the lifetime ISA, the rest of the ISAs don't have an individual limit. Lifetime ISA, you can invest only about £4,000. So you could decide to invest in all four ISAs. For example, in lifetime ISA, you could put £4,000, and the rest of the £16,000 you could put it into the three ISAs in whatever formats you want to put. 5,000 in one, 5,000 in one, and 6,000 in the other. You can do that. So it is up to you to decide how much you want to put into the rest of the ISAs. Except for lifetime ISAs, the other ones don't have a upper limit for the amount, but the overall upper limit is £20,000 in one financial year. You could actually put £20,000 into one cash ISA as well. You don't have to use the other ISAs. And you don't have to use any of the four ISAs for that matter. Another caveat is that you can't open the same type of ISA more than once in the same year. Like for example, you can't open two cash ISAs or you can't open two stock and shares ISA in the same financial year. However, you can open a cash ISA with one bank in 1 year, and the next financial year you can open the cash ISA with another bank. Same way, you can open a stock and share ISA with one bank in 1 year, and if you don't like their service, you still need to stick to them for that financial year. You can open a different one the subsequent year, and you can also transfer funds most of the time between the ISAs and transfer funds from one ISA into another ISA. When you file a tax return, if you are doing any stock and shares trades, or if you are doing any buying and selling of properties, or you get interest or whatever it is, even if you don't have to pay tax on it, you still need to include all of it in your income tax returns. You need to explain the full details to the penny of all of your income in your income tax returns. But if you put money into an ISA, whatever money you make from the ISA, you don't have to declare it in your income tax return. Everything that you get is yours to keep, and you don't have to declare it. You don't have to tell the HMRC in your income tax return about your ISA. So we've explained the cash ISA because it's one of the most simplest ISAs. It is just like another bank savings account. It's just that the interest that you get, no matter what, how much over interest that it goes into, you will not have to pay tax on it. But in today's climate, the maximum that you can put into it, let's say it's £20,000, which means that even if you get like 1% out of it, you're probably going to end up getting around £200 out of it. It's not worth putting it into a cash ISA, because if you keep it in a bank account, unless and until you earn above £150,000, you're not going to pay tax on it anyway. So the cash ISAs are not worth it. But the other three types of ISAs, there's a lot of benefit out of it, and each of those ISAs is a huge topic. So what we're going to do is, this is the summary of all the ISAs, and I'll try and make a video of all of those individual ISAs in detail, and preferably, hopefully before the financial year, which is the April 5th of 2020. Before the financial year ends, you have an opportunity to invest the whole amount, or whatever amount you have, up to the £20,000. So I'll try and make a detailed video on those three individual ISA types, and what the benefits are and why you need to open one. Then you can decide which one is probably better for you. You might think that this is probably not useful for you if you don't have money in your bank account, but even if you can invest up to £100 per month, so about £1,200, you could end up getting around £200 to £300 in return from a few of these ISAs. So we'll talk about it in the ISAs when we talk about them in detail. So hopefully this summary video was useful to you. So till we do the next videos, bye then.